Hey guys, I am here with my dear friend Rodrigo Suarez, who I met several years ago through the real estate industry. He's the co-founder and COO of HASTA Capital. Rodrigo, thank you for being with us today.
My pleasure.
So, without further ado, why don't you tell us a little bit about HASTA Capital? What do you guys do? Are you developers, investors?
So we're a Mexico-based real estate company focused on the multifamily sector. So we do a couple of things. We are developers of multifamily assets here in Mexico City, principally in Mexico, but soon the rest of Latin America. That's the plan. And we also raise capital to do U.S. acquisitions of multifamily, mostly with Latin American capital. I founded HASTA about 2 years ago with my partner, Mark Hafner. We were both at Greystar. Back then, he sort of like headed up the international projects for Greystar, and I was in charge of Latin America. And a couple of years ago, we decided to start our own company and focus on this sort of dual development in Latin America and acquisitions in the U.S. with Latin American capital.
Yeah, great. Yeah, I had the pleasure of meeting Mark. He's a really great guy, very knowledgeable, a true expert on multifamily.
Yeah.
And I met you several years ago when you were finishing up your MBA at Harvard Business School and starting to work at Greystar. And so tell us, now that you're in the multifamily space on your own, why is it that multifamily is such an interesting asset class to invest in, to develop? Why does everybody talk about multifamily?
Yeah, I know we're the cool kids, which is nice. So if you look at the sort of like large institutional real estate portfolios, particularly in the U.S., which is a really well-developed market, multifamily is sort of like at the top of the list in terms of these portfolios. And if you also look at the sort of like the cap rates at which real estate trades in the U.S., multifamily consistently has the lowest cap rates. And that's because investors recognize that the multifamily cash flows are sort of like more secure, safer cash flows, particularly during economic cycles. The best example of this is during the global financial crisis, 2008, 9, 10. The average multifamily portfolio in the US did not go below 92.5% occupancy in the worst part of the crisis. And at the peak of that cycle, it was at 96%. So an asset class, a real estate asset class, that from peak to trough goes from 96% occupancy to 92.5% occupancy, it shows you that it's very resilient through those economic cycles. So that makes them very safe and obviously very attractive to institutional investors.
And I assume that rents also stayed pretty
the rents
high.
Either have stayed flat or maybe declined a little bit, but the beauty about multifamily is that you don't really have really lengthy contracts, right? You have a much more pulverized rent roll, right? Like you'll have 300, 350 tenants in your building, and your average lease is going to be between 12 and 15 months. So even though like at the worst part of a cycle, you might have to give concessions, maybe sort of like effective rent has to go down a little bit. As soon as the economic cycle comes back, you can start raising your rent with that sort of like upswing in the economic cycle. So that allows you to keep your rent roll at the highest possible market level. With other asset classes like, let's say, office, if you're forced to lease your building during sort of like a bad part in the economic cycle, you're going to either be stuck with lower rents than you anticipated or with a sort of like high vacancy for a long period of time, which makes it a lot more sort of like aggressive during those downturns in the economy.
Yeah, so basically what you're saying then is that in multifamily, one of the main reasons is that you have short-term leases, and in office or in industrial and whatever other asset class, you have longer-term leases, and so that makes it, on the one hand, more attractive because you can get more of the upside. And then I guess the second thing is also the number of tenants that you have in multifamily versus like office or industrial.
So back in the 70s and 80s, when multifamily was really not an institutional real estate asset class, people thought that sort of like having so many leases was actually a negative, right? It's, if I have a Class A office building and I get, 3 big tenants, I have it leased up and sort of like I have a lot more stability. As the industry sort of like institutionalized in the 90s and the 2000s, people started realizing that pulverization of your rent roll is actually a benefit because you're not sort of like you're not dependent on one or two big tenants for your income, and you don't have these big swings in occupancy and vacancy. And that sort of like went hand in hand with the professionalization of the property management of these asset classes, right? Like back in the 70s and 80s, the property management of these assets was sort of like really mom and pop operations that would do, 2 or 3 projects in a particular city, in a particular submarket. And obviously over these years, it's been the boom in these sort of like very large professional property management companies that, somebody like a large endowment or pension fund or sovereign wealth fund can feel very comfortable in trusting sort of like a large portfolio because they'll have that institutional quality property management.
Okay, that makes sense. Okay, and so back to HASTA. You guys have been pretty active. You have deals in the U.S. and you have deals in Mexico. So many of our viewers, they're interested in kind of learning from professionals such as yourself and people that are expert in the industry. You have a deal in Washington, D.C., for example. Can you kind of walk us...
5 deals in Washington, D.C.
5 deals, wow, that's impressive. Okay, yeah. So walk us through kind of the investment thesis or the investment rationale for why you would make, one of these acquisitions. I assume that these are income-producing properties, or are you guys developing there?
No, right now in this part of the cycle, we're just doing acquisitions of stabilized assets in the U.S. When you're doing acquisitions instead of development, you have to look at the investment a little bit differently. And for us, first we look at why we like a submarket in particular, and then we go look for the best possible assets in that submarket.
Okay.
Over the last 15 months, we've acquired about 7 buildings, so it's about 2,000 units. And 5 of those 7 are in the Washington, D.C. metro area. So obviously we really like Washington, D.C. as an investment.
Great.
And the reason why we like it, the story goes back to the global financial crisis, where obviously during that crisis, it was impossible to capitalize new developments in any asset class, but multifamily as well. So basically no one was building anything new because you just couldn't get either the equity or the debt to do a new project. What happened was that as the crisis abated, the first market to come back was Washington, D.C. Washington, D.C. has the big inertia of the federal government, and obviously during the financial crisis there was a growth in federal employment and all that stuff with like TARP and all these federal programs. So because of this kind of like big inertia of the federal government, that was the first market that came back where people could actually capitalize new deals. So what happened, every single developer in the market went and built something in Washington, D.C. because literally it was the only place where they could build anything. So during those first few years coming back from the crisis, a lot of inventory started construction. As that inventory started being delivered in Washington, D.C. was during the beginning of Obama's second term when he lost control of Congress. And you probably remember, but the Republicans passed the Budget Control Act. They called it the sequester, which meant that they did aggressive reductions in federal spending. So it was something that almost never happens in the U.S. happened, which was a contraction in federal employment. So just as all this sort of like huge wave of supply was hitting the market, the demand went down because of this sequester dynamic. And rents started going down slightly. I think the rents went down maybe like 2% in the market. But they went down 2% just as all the other markets in the US were coming up and the rents were growing at a very attractive rate. So all of the big institutional players decided that DC was a terrible place to invest and they pulled out of the market. And usually these bigger kind of like endowments, investment funds, sovereign wealth funds, they move a little bit in herd mentality. Yeah. So they all kind of like pulled out of the DC market at the same time. And this lack of liquidity meant that the cap rates in DC went up. Now, obviously cap rates all around the US are relatively low. We're kind of like in year 10 of the cycle right now. But when we look at the cap rates in DC in particular compared to its comparable market, so DC is one of those gateway markets, they call them in the US, so it's comparable to Los Angeles, Seattle, Boston. And suddenly when this was happening, the cap rates in DC were 100, 150, maybe 200 basis points higher than in Los Angeles. Now there's no secular reason why cap rates in DC should be higher than Los Angeles. They usually trade within 25 basis points of each other. But there was this one particular dynamic where capital pulled away, so the cap rates went up, and we realized that it was sort of like comparatively cheaper to go buy DC than any other market. So that's why we like DC, and that's why over the last 15 months we've focused there and been able to put a lot of capital to work there.
Okay, so you like DC, and so with HASTA, what you guys are doing is you're going into this market and you're buying income-producing assets at, I guess, replacement cost, or maybe even below replacement cost. Below replacement cost. Okay, so that's one of the key things, right?
Yeah, absolutely.
Behind it. And then what you're doing is, are you fixing anything, or are you just holding these assets and then looking to sell?
Yeah, that's the other part of the strategy. There's a couple of different ways to do acquisitions, particularly in the US. There's the value add strategy, which everyone's heard of. And in the classic value add strategies, you go buy a building that was built maybe in the 80s or 90s. Yeah. You renovate the kitchens, you renovate the bathrooms, you maybe take the carpets out and put hardwood floors, and then you have a rent pop, and then sell off of that rent pop. And that strategy is very popular. And just because you get like a slightly higher return than just buying a core stabilized asset, on these last few years, as we get kind of like later in the cycle, it's been kind of like the most popular way to invest in US multifamily, which means that the prices are just way too high for what we see, right? Most of the value that you generate with that renovation program is already priced into the acquisition because there's so much capital chasing those value add deals. So something that we recognize is that you could find assets that were newer, and since not a lot of people were paying attention to sort of like the newer assets, they were focused on this 80s, 90s value add stuff, you could actually get assets for a price per door that was actually very similar to the post-renovation 90s product. But no matter how much you change the kitchens or the bathroom in a 90s product, usually they have 9-foot ceilings, and you're not going to be able to raise the ceiling in an asset no matter how much you renovate it. So what we're focusing on is actually newer assets that are coming out of lease-up in markets that we like Washington, D.C., that for whatever reason in particular, that asset had maybe a complicated lease-up story where we think that the rents are below where they should be and the operating expenses are above where they should be. And we definitely do sort of like maybe targeted renovations. So for example, we bought an asset in Germantown, Maryland, from Wood Partners, which is one of the most sophisticated multifamily developers in the U.S. And the units are beautiful, but for some reason, the entire unit has hardwood floors except one little square where the living room is, which we don't really understand why. So what are we doing? We're ripping that carpet out and putting hardwood floors, and we're not expecting a huge rent pop, but we are doing sort of like super targeted, kind of like small value add things like that. But mostly we're buying newer assets that for some reason we feel where the rents are lower than what they should be and the expenses are higher than what they should be. And doing a very active asset management is sort of like that reduction in operating expenses and slight increase in the rents, and just with that we're getting to really attractive returns with obviously a much lower execution risk, so we're not changing kitchens and bathrooms. But we can get to sort of like, value add like returns just by being very selective and finding those assets where you can execute that strategy.
Okay, how interesting. So by value add returns, you'd mean like, in terms of yield on cost, maybe like anywhere between 8 to 12% yield?
No.
What yields are you seeing?
So so multifamily cap rates in general in the US vary widely. So like the New York's and San Francisco's, forget it, like maybe 2.75% cap rate is what you're acquiring at. The LA's, Seattle's, Boston's, maybe around 3.75 is sort of like a regular acquisition cap rate right now. The stuff we're buying in DC, we're getting closer to a 5% cap rate. But obviously, kind of like with the increase in rents and decrease in operating expenses, we do a little bit better than that over the hold of the asset. We can negotiate really attractive debt terms, particularly with the agencies, Fannie and Freddie. And we're looking on a 5-year hold. IRR is anywhere between 16 and 20% for our assets, which is value add returns.
Yeah. Okay. Great. How interesting. And so one question that I've been asked in the past is, and we were taught at business school that there's a first mover advantage, right? Meaning that a company or a player that enters the market before most other players would have some sort of advantage.
Sure.
It seems like in multifamily you can be late to the party, or you can actually be contrarian, right? You can be buying things.
Yeah, it's the small mover advantage, right?
Yeah.
So in a market that's really deep with such great players, right? I mean, there's the Starwoods and the Greystars and the Blackstones of the world. That question that we get asked is, your small operation, how can you compete with them? And the reality is that we can be a lot more nimble, right? Like we said, the capital sources from these big players are the large institutions and sovereign wealth funds, and they're a little bit slower to react to the different market trends. So like I said, a year and a half ago when we started buying Washington, D.C. had a big red X in most investment committees for most of these big institutional funds. Right now they're all coming back. So by being small and more nimble, by sourcing our capital from smaller and more nimble investors, we can move quicker, be a little bit contrarian, and get ahead of the wave to be able to source these opportunities. Also for us, right, sort of like assembling that 7 assets, 2,000 unit portfolio is amazing. For Blackstone, if they bought 2,000 units in 15 months, that's a catastrophe for them, right? So we can look at sort of like more niche or targeted opportunities because we just don't have the necessity to put $4 billion to work every year to justify our size.
Yeah. Okay. And for the average person, let's say the average person watching this is working at a consumer goods product, 9-to-5 job, looking at real estate as a side business. They've been told that real estate is a type of easy industry where everything is fast and no money down and all these infomercials. But the realities are different, right? And you have to have a longer kind of point of view, and you need to be really patient, and so many other things. From your experience in real estate, you would say then that your favorite asset class is multifamily? Yeah,
obviously. I've bet my career that I really like multifamily, and it's not just the sort of like return dynamics and the attractiveness to investors. The reason I like multifamily, I like of all the real estate asset classes, I like housing because I feel that that's the one where you have the most direct connection with the end user, right? Yeah. The decisions we're making are the decisions that are going to affect how somebody lives in their own home. So when I compare that to an office building where you're sort of like leasing out cold, dark shells, you're sort of like really far removed from that end user. And personally, I find that direct connection with the end user very, very attractive.
Okay, great. And we have obviously also a lot of entrepreneurs watching, right? And I've been asked throughout the videos that we put on the channel, what type of advice would I have for entrepreneurs? I'd love to kind of hear your advice. You're a successful entrepreneur. What would you say would be, as you look back at your career, what would you say are the most important things as these people look to become Moses and cross the desert?
So I don't know how useful it's going to be to the viewers, but the most important for me as an entrepreneur has been my wife, for sure. The support that I got from my wife when I decided to get out of Greystone and start my own company, the support that I've been getting from her since, just that sort of like stability and having that kind of like rock amid this crazy chaos that is starting your own company. Like I really definitely could not have done it without her. So I guess my advice is find a really good wife like mine. I guess I don't know how hard that is.
Okay, so recommendation number 1: marry a saint.
Marry a saint. Yeah, okay. That's number 1. Okay. No, for sure.
Look, it's good advice.
Like starting a company is like going into the middle of a tornado, and it's just very stressful, and the highs are highs, the lows are lows. Because like you know that better than anyone. So having stability in your personal life allows you to have all this volatility in your professional life. And if there was volatility in both, really, there's stronger people than me that can do it. I definitely couldn't have done it. Have done it without her.
Okay, great. So Rodrigo, as you look back at your career, what are some things that you wish somebody would have told you, when you were graduating undergrad? You're finishing college.
Yeah, so I'll go even before. Right?
Yes,
so,
please.
So when I was younger, I wanted to be an architect, and then eventually I went to school for civil engineering, and I was a structural engineer. And when I started working as a structural engineer, I realized, wait, there's a guy called the developer, and he's the one that's making all the decisions, stays with the project from beginning to end, like keeps all the money. Like, who's that guy, and how do I get to be him? Unless you have someone that works in the real estate industry, sometimes it's hard to really understand how it works. And I definitely didn't understand it, right? I love buildings. That's my passion, and that's why I wanted to get into building somehow, and that's how I ended up being a structural engineer. If I had known that there was this thing called a real estate developer, maybe I would have started my career in real estate as opposed to having that detour. Now, it wasn't a bad thing, right? I love being an engineer, sure. And it was great preparation, and I think I'm a better developer now for having done that. But I really just did not have a very good understanding of how the industry worked back when I was 17 and making decisions of sort of like what to do with my life.
Sure, yeah. that makes sense. And one big question, in a lot of people's career as developers and investors in real estate, and really almost any part of the real estate industry that you're in, is the issue of leverage, of financing, right? Yeah. And so in your career, you've obviously been involved in several different projects, and a lot of them have had debt, right? Lenders giving you money for construction or refinancings or whatever it may be. How important do you think is debt?
So yeah, debt is extremely important in real estate. In the U.S., one of the reasons why multifamily works so well is the debt, right? It allows me to buy a building at a 5% cap rate, which means 5% yield on cost, and take it up to those 15-20% returns for my investors. So it really it allows you sort of like to have that positive leverage, and it's pretty instrumental to the industry. Now, coming to what we do here in Mexico, which is a much more nascent industry, it's interesting, right? Because debt is not so readily available, particularly construction debt for multifamily. Sure. For a while it didn't really exist, and then it existed, provided by a sort of like a government development bank, and sure. Now we're in a political transition, and we don't know if in January that's going to exist or not. So the reality is that there is a way to make projects work without debt. So more so than that debt being necessary for real estate, debt gives you sort of like the valuation conditions. If it's available, then valuations are going to be higher because you're going to be able to lever your returns. If it's not available, the valuations are going to be lower, the cap rates are going to be higher, but you can still get attractive returns for your investors. You just need to get like the lens through which you see a project and whether it's attractive or not is going to be very different if that debt is available or not. Obviously, long term, sort of like real estate is a very leverageable asset because you have it's a great guarantee. It's a real asset. It's bricks and it has intrinsic value. So it makes sense to utilize that debt to increase the returns because having that debt does not put the project in too great jeopardy as long as you're being responsible with it. So long term in sort of like Latin American markets where debt is not available yet, it's going to be important for that to develop because it really is a boost to the market when that happens.
Sure. And you talked about responsible. What would you say is being responsible in terms of obtaining debt? Up to how much would you advise anybody that wants to sleep at night and survive these imminent recessions, right? Because debt is something wonderful. Sure. But at the same time, the highs are very high and the lows can be very low. So, what would you say? Is it 50%, 60%? What is the number that you feel comfortable with that no matter what recession comes through, you can weather the storm in multifamily?
So in the U.S., our assets we're leveraged no more than 65%, and that makes us extremely comfortable. We could definitely go higher than that, but we feel comfortable, and at that 65% level, we can access the debt from the agencies at really attractive conditions that make up for the fact that the leverage is not as high as it could be. So we feel super comfortable with that 65% debt. Here in Mexico, on our developments, we really don't like going higher than 50% because obviously it's development risk and it's pesos and the interest rates are higher. So you have to be a little bit more cautious. But I would say sort of like it depends. It depends market to market what you want to do with that.
Sure. Okay, great. So I guess, one of my final questions would be, they say that the world belongs to those who read, and I love reading, and there's so many great books out there. If as you look back, at your career and, the many books that you've read, which ones or which one come to mind that you would recommend readers just in general about anything, right? That doesn't have to be real estate.
So I think my favorite book is Robert Caro's The Power Broker. And it's like, if you don't know about it, so it's about this guy, Robert Moses in New York, who was able to accumulate a massive amount of power and had huge influence in the city, and some for good, some for bad. I mean, he wanted to drive a highway through the West Village, which we would all think now it's probably not a responsible thing to do. But I mean, Robert Caro is probably the greatest biographer of our lifetimes, if not ever. It's a really thick book, and I was reading it when I was living in New York. So I took a knife and I cut it in three and sort of like rebound it, and that way I could just take smaller pieces of it with me on the subway. It's an amazing read.
So The Power Broker.
The Power Broker, yeah.
Able to get. Okay, awesome. And where can people learn more about HASTA Capital?
So we through me, I guess. No, we have a website and we're usually posting there the stuff what we're doing, the new deals that we're buying. We're a little bit low profile, but yeah, our website I guess is the best.
HASTAcapital.com.
HASTAcapital.com.
All right, so we'll also have a link down below.
Great.
All right, great. Well, Rodrigo, thank you so much for your time.
My pleasure.
Really appreciate it. It was great seeing your offices. Very trendy co-working spaces here, and we will be in touch.
Great.
All right, thank you guys for watching.
Thanks.